The Alpha Horizon. Thinking different. Acting aware.
Welcome to this latest edition of the Algebris Alpha Horizon podcast. My name is Douglas Branson and I'm Head of Business Development at Algebris. I'm very pleased to be joined again by our investment strategist, Simon Peters. Hi, Simon.
Hi, Doug.
Following on from our last podcast, in which we discussed the compelling environment for financial equities, today we're going to talk about the opportunity in financial credit. So diving straight in on the first question, Simon, the US Fed has committed to hold rates near zero for the foreseeable future, but market expectations for economic growth and inflation have been improving. Longer-term bond yields have been rising globally. This creates a significant headwind for fixed income investors. So what are your views on the fixed income market, and can you provide some context for our listeners, please?
Well, thank you, Doug, and you're right. Taking a step back, fixed income investors have a problem, and it looks likely to get worse before it gets better. As you mentioned, central banks have reduced policy rates to negative or zero globally, but they've also been buying large swathes of the bond market through their QE programs in response to the COVID pandemic. As a result, yields hit all-time lows for the last 40 years in the second half of last year. Spreads are also close to all-time tights. To put it bluntly, there isn't any yield out there. Currently, 27% of the bond market is negative yielding, and 94% yields less than 3%. So no yield, but there is plenty of risk. And to compound that problem, with long-term yields starting to back up from all-time lows, the capital gains that investors have got used to have also disappeared and are now beginning to reverse. Now, perhaps the biggest risk to the bond market is that COVID isn't quite as bad as our worst fears of last year in March and April. We had the largest GDP drawdown in a century, but globally, governments and central banks stepped in, providing huge support. And as the vaccine is being successfully rolled out in the US, the UK, and belatedly, even in continental Europe, economies are bouncing back quite strongly. Combined with the large fiscal support that is coming online right now, the start of a new economic cycle is likely to see bond yields continue to rise, which will prove problematic to the average bond investors as bond prices potentially fall or remain flat.
Great, thank you. So picking up on the point, the majority of the global fixed income market currently yields less than 3%. And of course, a significant part of it is actually negative yielding. We know that financial credit is one of the few areas that offer an acceptable absolute and a fantastic relative yield. Can you explain what's on offer and put the risk reward into perspective, please?
That's correct, Doug. Subordinated financial credit in the UK and Europe is currently yielding between 3 and 4%, and there is a decent amount of excess spread as well, which gives the prospect of an additional capital gain on top if and when that starts compressing. Let me briefly discuss the fundamental investment case. The financial sector is heavily regulated, and so if we take companies like HSBC, BNP, UBS and Santander, they all have investment-grade issuer ratings as one might expect. And investment-grade issuers rarely default. However, regulators require all banks to issue subordinated debt. We find investing in these strong investment-grade issuers, but in the more junior parts of their capital structure, provides a very sensible risk-reward investment. Of course, banks did not stand up well in the global financial crisis back in 2008. The regulator has since required banks to increase their capital ratios, their ultimate strength, by an average of 3 times, and also reduce their risks. However, it was still an open question of how they would perform when the next recession hit. And in fact, COVID-19 saw the worst GDP drawdown in 100 years, so it was not obvious in March or April of last year how they would cope. In fact, the banks performed robustly. Not one European bank required a capital raise. Bank capital ratios were higher at the end of the year than at the beginning. And although profits dipped in the first half, they started recovering strongly in the second half of last year, and the regulator is allowing them to pay dividends again. What that means is the bank sector remained resilient throughout the crisis last year, continued to build capital, and got stronger, not weaker. And so I think we in the markets will finally say, after more than a decade post the global financial crisis, that they are finally fit for purpose. That is good news for debt investors, as not only do you get to clip some of the highest coupons out there, but there's also the additional prospect of some spread compression as investors begin to take this opportunity.
Now, of course, the pandemic has had a dramatic effect on most asset classes, and some have benefited while others haven't. How has it affected financial credit?
Initially, spreads widened, along with the whole bond market, as investors were unsure how severe the economic downturn would be. However, within a couple of months, the bond market and financial credit had bounced back strongly, and we also began to see some interesting new issuance, which we participated in. In the second half of last year, it was clear that the banks were digesting this economic crisis in resilient form, and so debt investors became increasingly more relaxed. One point I should highlight is that the QE programs of central banks have been huge bond buying operations, thereby driving prices up and yields down. That we all know. However, because central banks are the regulator of the bank sector, they decided not to buy bank bonds due to the perceived conflict of interest. So without the £800 gorilla of central banks buying bank bonds, they have been left with an acceptable yield, something that can't be said for the rest of the bond market. Essentially, investors have been left with one area of the market that hasn't been overtly manipulated by central banks. An interesting point is that the financial sector is one of the few sectors that also benefits from bond yields going up, so the fundamentals are improving for credit investors.
Understood, thank you. Now, the bank sector is strong and has got through the COVID recession in good shape. What's the current state of financial credit, and how does it compare to 12 months ago?
Well, despite the strong double-digit performance of our various financial credit strategies last year, perhaps the most surprising statistic is that spreads in the junior part of financial credit, the additional Tier 1 securities, have wider spreads today than pre-COVID. So forward prospects are actually probably better today than last year. In a broader context, decent opportunities in both the fixed income and equity markets appear more limited now than a year ago, given that both bond and equity markets are close to or at all-time highs. So when you add those together, that prospective returns are better and that the alternative opportunities are fewer, there is likely to be a significantly more investor attention spent in this area of the market, which is why I would expect the excess spread to narrow, providing an additional source of return to investors over the coming 12 to 18 months.
And moving to the last question, can you just offer a couple of comments on where to look for yield and diversification in a market that's seemingly devoid of exactly these opportunities?
Well, you're right. Take the sovereign debt market, for example. There is significant supply issuance coming. Little to no yield, and long bond yields are likely to continue going up. Not a great prospect. And the highest rated company bonds also have similar prospects. We've talked about financial credit as a rare opportunity. Another one outside of financial credit, our global credit strategy is focusing particularly on convertibles, which it sees as a sensible risk-reward, providing a more linear upside-downside profile than the rest of the bond market. Outside of those two areas, perhaps the most significant opportunity out there is in the most junior part of the capital stack, namely financial equities. Having endured a lack of capital post the global financial crisis and needing to get in better shape, the COVID recession showed that they are finally fit for purpose. With capital ratios the highest they've ever been, profits recovering, the most positively geared sector to higher bond yields, and yet in Europe at least, with the index at close to 20-year lows in the financial sector, financial equities should be on the radar of anyone who has the capacity to invest in equities. And investors don't get in there first. It looks like the biggest M&A wave in over a decade by insiders is currently underway to take advantage of this opportunity.
So thank you for listening to this edition of the Alpha Horizon podcast, and thank you, Simon. As mentioned, the purpose of this edition was to offer our thoughts on the challenges that investors have in terms of accessing yield and diversification in the current environment, and also to highlight the opportunity presented by financial credit to address these specific challenges. So thank you again, and until next time.
The Alpha Horizon. Thinking different, acting aware.